we're going to be talking today about escaping the trail. Can digital currency fuel the tokenized asset market? So Gartner's latest report highlights that tokenization is in the trail of disillusionment, meaning mainstream adoption is 2 to 5 years away. At this vital juncture, are digital currencies the push the market needs to accelerate its growth? So really looking forward to discussing this with the panel today. Got a really great lineup. I'm Emma Joyce. I head up EMEA and financial services for GBBC. We're the largest blockchain and digital assets association in the world, approaching 600 members, and with people in our team based all over the world and on the ground in the UK, US, Asia, all over. So I'm going to ask my panelists to introduce themselves before we get into the topic.
You're okay for the minute, yeah.
Can is this working? Yes.
It is, and Helen's mic is still working.
Yeah.
Turn it off before something happens. Thank you, Emma. Thank you, everyone. Good morning. My name is Francesco Pierangeli. I'm the co-director of the Master in FinTech program at the University of Birmingham, where I'm also leading the module on blockchain, financial applications, and cybersecurity. And I'm also the Deputy Director of the UK Centre for Blockchain Technologies, which is a group of academics from all around the UK trying to advocate for good use and of blockchain and trying to advance the blockchain agenda in the country.
Hi everyone, really glad to join you today. I'm Anoosh Arevshatian. I'm the Chief Risk Officer at Zodia Custody, which is a digital asset custodian globally that is owned by Standard Chartered, Northern Trust, National Australia Bank, and FBI Digital Asset Holdings. Hopefully I haven't forgotten any there. Really excited for this topic.
Thank you. Daniel?
I'm Daniel Coheur. I'm the co-founder. Can you hear me?
Yes.
Okay,
Yeah.
excellent.
Well, I can. Hopefully you can.
I'm the co-founder of Tokeny. Tokeny is a fintech based in Luxembourg. We started 7 years ago. We're a team of 50 people, and we provide the part that most of the people define as being easy, technology. So we enable the creation and representation of digital instruments on public or private ledger using a framework, the ERC 3643, which is something we've developed and submitted to the Ethereum community last year. Moved to final stage, so now this is an official standard.
Daniel's mic is not working.
Aha! Speak up. So, I'm not going to start from the beginning again. Maybe on the last part. So, we are the source of a framework called the ERC 3643 that we submitted to the Ethereum last year. It's not an official standard of Ethereum, therefore it's fully open source and governed by the Ethereum community. This is the only standard on the top of the ERC20 that is used for digital assets, and it's leveraging the ERC20 standards, but it's adding an element of compliance and governance. So it enables to link the token with an identity smart contract, not a wallet, which ensure KYC and AML. And we now have 75 members in this association, including the like of ABN AMRO, Apex, and other very large financial institutions.
Andy's my favourite Luxembourger.
The only one you know, probably.
Yes, you want to know, that's true. Don't let the facts get in the way. Good story, I told you that before. My name's Jonny Fry. I work for a company called ClearBank. How many of you heard of ClearBank out of interest? A bit of market research. Blimey, it's getting better. The PR's obviously working. ClearBank, rather unusual, they're the first bank in 250 years to be granted clearing bank status. And having built effectively a fintech infrastructure provider, we now find ourselves at an interesting juncture that our clients have only got about 270, ranging from very large global credit card companies down to small sort of fintech businesses. Unlike many clearing banks, we're not frightened of crypto. We actually bank Coinbase, Kraken, and Crypto.com because they're all regulated in some shape or form, and therefore we are happy to engage very much with the tokenized space. Having said that, we always like to bear in mind that the crypto market is a couple of trillion, and I know many of you heard me say this loads of times before, but the real world of equities, bonds, real estate, and the big daddy is derivatives, which I know Richard Barker at the back of the room will no doubt talk about during the day. It's 2.2 quadrillion, and we think that a big chunk of that 2.2 quadrillion over time will get digitized, tokenized, and therefore We would disagree with Gartner's. We think that we're actually an inflection point, not a trough of disillusion.
Okay, that's a good start. Jonny, can we stay with you? Are you happy to talk us a little bit about maybe some of the projects?
Sorry.
Can you talk us through some of the projects that you're working on maybe in this space at the moment?
Well, rather talking sort of about stuff that ClearBank's doing, well, what ClearBank are looking to do is to create basically a suite of digital payment options. So we would refer to it as a digital bank account. For many of you, I'm sure you go traveling overseas, you probably have at least 2 debit/credit cards in on your phone, or if you're an old devil like me, you have a wallet still. And one of them is a credit card, and one of them is a challenger bank. Something like a Tide, a Starling, a Revolut. For the simple reason that if you use your, I have an Amex card, if I use that because I get more air miles, if I use that overseas, the cost differential can be between 5 and 10%. So that's why I use someone like Tide or Monzo or Revolut, because they're actually cheaper. Because that's just the way it is. What we would like to do is to create effectively a bank account. So let's move on from these memorable passwords, these strings of letters and what have you that you forget as soon as you create them, and have a bank account that we all understand. Because it's interesting, and I'm really annoyed that the old prof has gone, because I disagree with a lot of what he's saying, and I disagree with a lot of this talk about the singleness of money. And I think this is really important, because money at the moment it takes on different formats. For those of you who have some in your pocket, in your wallet, in your purse, your handbag today, that is cash. Whereas if you actually could give your money to a bank, then you're actually using a credit instrument. And we believe there's a huge opportunity and a lot of interest for actually to create a bearer instrument, but with a digital fingerprint. And that goes back to having something cash. It's something physical, it's something tangible. At the moment, we are trading, as the Lord Mayor said, we're trading something which is really an IOU backed by the ability to tax you. So what we're seeing is a lot of companies that are interested in creating the ability to have 24/7 independent pricing. So if you look at the fund management industry, the top 500 asset managers in the world, they look after about $128 trillion. That's about a year out of date, but these things take about a year to come through. And we're already seeing some of the biggest the biggest asset managers in the world is BlackRock, about 10 trillion under management. But you've got a variety of other asset management companies that are tokenizing their funds. And you're probably thinking, well, so what? Well, one of the largest asset managers about to tokenize their money market fund will calculate the interest on their money market fund every hour. Now, for you and I, again, so what? But if you're a corporate treasurer and you've got maybe 10 or $20 million, or pounds, or euros, or yen, actually knowing what interest you are able to actually earn hourly is actually quite important. And if you're going to have that paid, instead of being paid every 6 months, which is the current situation, it's now going to be paid monthly, or it's going to be paid weekly. So the reason ClearBank are interested in this is that, having run an asset management business for over 20-odd years myself, payments were a pain. And if someone can take that pain away, someone can actually provide that. Potentially, I think we could see weekly payments on your investments, whether it's equities, whether it's bonds, or whether it's money market funds. And I think it'll get driven by compliance, because it's that old-fashioned thing of treating customers fairly. Instead of waiting every 6 months to get your interest, instead of having the fund manager and then his or her colleague pricing the fund, the pricing should be done independently. In the same way you have with shares and quoted bonds and ETFs, it's independent pricing. You don't have that with funds at the moment, and that can potentially lead to conflicts of interest, and we've seen that. So I think for those reasons, I think we're going to see tokenization of funds, and we're already seeing it in the repo market, we're already seeing it in the debt market. So I think it's going to happen quite quickly because of compliance more than anything.
Lovely, thank you. Daniel, what are your thoughts on what's Tokeny up to?
Well, obviously, Tokeny is a technology company. So what we've been working on is enhancing the technology. So everybody make reference to tokens. So tokens are using this notion of smart contract. So what you can do is to bring the intelligence in the assets itself and not on the network. Until now, you have representation of assets on vertical silo, being mainframe, etc. So it was a binary representation. It was done that's why you needed third party in order to take responsibility for whatever action needs to be taken on those assets. Now that you have smart contract, you can bring intelligence in the token, and therefore remove the need for having third party doing a lot of things. You don't remove the need for having those third party. Maybe the business model would change, but you don't remove that. So what we've been doing is leveraging the framework that we've been developing in order to enhance the capability of the smart contract. So the thing we're working on now is really a lot around automation. The basic framework enabled to create a representation on chain of a cap table and ensure control and compliance. Now, if you plug other smart contract into the framework, which is called composability, you can start automating other process. So one thing we're looking at now is a project with ICMA, the International Capital Market Association, to link the taxonomy. In the taxonomy, by the way, they define specific roles. So to link this taxonomy with the compliance frameworks, that you can start automating the issuance, corporate action, and redemptions. We're doing the same thing with money market funds, so you can fully automate on-chain the subscription into an open-ended fund. There's still some need for external interaction in order to calculate the NAV and get that NAV funded into the subscription itself, but you can now fully automate this process end-to-end, reducing the time and cost associated with those transactions. Then we are also looking more on the side of the association on other topics. Someone asked about confidentiality. So there are solutions now that enable to bring confidentiality on public chain. So if you want to bring confidentiality, you either do that on private chain. If you want to do that on public chain, then you need to add some element of anonymization. So we work like a company like Zama, for example, that are bringing the ability to encrypt every single element of a transaction to bring that level of anonymization that is required for large financial institutions. So, and the other thing is, of course, account abstraction. That's a hot topic. Account abstraction dissociates the identity of the owner with the wallet, so that enables you, for example, to use any form of current authentication that you have in your enterprise, and to link that with what we call a paymaster. Paymaster is the one that's operates the wallet and pays the gas to the network, so you can decorrelate the wallet from the owner and therefore facilitate adoption of the technology. Just a few things we're doing.
Love it. Thank you. Anoosh.
It's tough to keep up with that one. I think as you think about it, and just thinking about the tokenized economy going forward, the way I like to think about it is three things. You have the technology, which already exists. I think that's been the boon of the past 5 years in terms of every year we keep saying this year is the year of tokenization, this year is the year of tokenization, and it keeps going on. So the technology is there. You need the operations, right? And when I think about the operations, I'm including things in there such as the regulatory compliance, including things such as the private-to-private collaboration, the private-to-public collaboration as well. And then eventually you also have the use cases, which I think are the most critical element of whether or not this will truly take off and be mainstream adopted. And if you think about the use cases over the course of the past 4 or 5 years, everything that can be tokenized has almost been so. And what we really need to think about is solving pain points at the end of the day, very much to what Jonny was mentioning earlier, solving pain points for our clients, whether that's for trade financing purposes we were speaking about yesterday, whether that's for cross-border payments, whether that's for atomic settlements as well. I think this is where what we're trying to do at Zodia Custody, at the end of the day with digital assets, custody, I like to think of it as the foundations or the plumbing. We ourselves might not be doing the sexiest of activities, but at the end of the day, custody is an essential in terms of any kind of institutional safekeeping, auditing, regulatory compliance, and at the end of the day, also connectivity to all of the rest of the participants. So what we are trying to do as part of our value proposition is connect with the likes of the rest of the participants in the ecosystem, the likes of the Tokenys, the likes of the ClearBanks, and to build out that ecosystem so that at the end of the day, you have a connected and mature integration across participants.
Great, thank you. Francesco.
Fantastic. In our case, the center, our work is really organized along 3 main verticals, one being research, obviously. We produce research papers in different fields related to digital currencies, but taking different approaches, say in computer science, economics, fintech, law. Recently, also something more interesting was coming up as a, kind of an ethnography of the crypto communities, with something that comes from, say, anthropology, so it has nothing to do with computer science or econ, so something definitely interesting to look at in light of, some of the interesting projects such as penguins or whatnot. So it's something interesting to look at as well. But we also publish, we publish reports. For instance, we recently edited a report on the future of work with the Solana ecosystem. We clearly run, the second vertical is education. So we run a series of modules at a university, at both undergrad and postgrad level. We also offer modules on blockchain, on digital currencies at MBA and executive education level. We run a series of seminars and workshops open to everybody, aiming at educating the public on new technologies such as blockchain. We recently invited subject experts from the industry. So we run one seminar on DeFi and AMM inviting speakers from Ripple, and one on digital assets in the UK with Polkadot. So we really engage with the crypto industry and blockchain industry, wider blockchain industry. Finally, the third vertical is community building. So we organize hackathons where future entrepreneurs can meet and can actually experiment and build on chain, which is super important. And you see a lot of talented students wanting to, go there, build on chain, and also engage with other people who are like-minded. And finally, we also contribute to the decentralization of crypto projects. So we run a number of validators. So we run a number of nodes. So beyond that, what we do, we engage with regulators. So we participated in the crypto assets policy roundtables earlier this year, offering our expertise. We also engage with policymakers. So we engage with the APPG, which stands for All Party Parliamentary Groups in Parliament that are focusing on blockchain, on digital finance, so on and so forth. Actually, it was yesterday in Parliament. I was invited by one of the largest VCs in the world, A16Z, which offer a parliamentary reception there with the new MPs coming. I was really pleased to see that there are, I would say the new MPs are probably more tech savvy than the previous bunch. At least they seem like to be more tech savvy. It doesn't matter Labour, Conservatives, or Lib Dem. And also we established strategic partnerships in the space, such as the one that we have in place. And we are delighted to have signed a memorandum of understanding with the Digital Pound Foundation. And finally, last but not least, we bid for large public and private grants and trying to, again, put in place projects that go into the direction of interoperability, evaluating security, and doing research, very advanced research in terms of systemic risk, in terms of anything that can derive, that can actually benefit the financial infrastructure.
Thank you. Anoosh, when we're looking at mainstream adoption, what do institutions need to do to get ready?
I think it's really important, right? And this is where I think the industry is still very fragmented, right, in terms of any kind of off-chain and on-chain connectivity. And what I mean by that is typically there are various different touch points, obviously ClearBank being one of them, in terms of being able to convert fiat currencies, get them on-ramped, do so in a compliant manner, and at the same time have all of that traceability of the assets, right? Be able to meet all of the requisite regulatory requirements that are in place. Beyond that, depending on the type of the asset as well and the underlying, what the digital asset represents, I think where we run into some problems is essentially the fragmentation globally of different requirements. Some jurisdictions are a little bit more advanced in terms of their regulatory status, in terms of the scope of the regulation as well, moving beyond money laundering registrations and looking more towards stablecoin guidelines, for example, or even further guidelines in terms of being able to use digital assets as collateral, which is another use case, for example. So I think where institutions and where the industry overall needs to improve is in that cross-participant. There should be a network of custodians, there should be a network of banks, there should be an inbuilt almost settlement connectivity between the custodians, between the banks, between the off-chain data and the on-chain data as well. And we should really try to work together at the end of the day. I think this isn't a one winner takes all, but it's more so a maturity of the industry overall and a working together cross-participant to try and understand what are the pain points that we can solve together and how do we do so in a compliant way. How do we work together with regulators globally as well in order to build this up together?
Always a big theme this year, collaboration. You touched briefly on regulation. As we start to see those regulatory frameworks developed around the world, do you think that will move quicker next year at all? Do you see it moving in the direction we need?
So I'm just speaking about my experience in the UK here. I've absolutely seen an acceleration, I would say, in the past 12 to 18 months, comparing that to the past, in terms of the willingness, the desire to work together, the desire to bring in industry participants across the board, both in terms of digital assets native firms as well as more traditional financial entities. So I think we're headed in the right direction. I think this is where the UK needs to take advantage of its second or third mover advantage here. You've got the likes of the EU releasing MiCA, which, whether you agree with it or not, it is, if you think about it, it's been influenced heavily by MiFID. Almost the EU's hands was forced by the likes of Libra and the old DM project from Facebook. And if you think about this, we can really take the learnings from there and try to understand how can we build clarity, number one, which is the most important for institutions. It's having a set of requirements or principles to abide by, typically leaning heavily on what we already have in the traditional financial space. But beyond the clarity, I would say the second really important thing is the practicality. You don't want to have unintended consequences in terms of releasing new regulatory requirements. Francesco earlier was talking about systemic risk and concentration risk. I feel like these are some of the areas where inadvertently, by creating overly stringent regulation that in theory sounds great, in practice you may end up resulting in a few key service providers holding a significant proportion of the risk, and at the end of the day creating quite a systemic issue overall.
Daniel, what else do institutions need to do to get ready?
Well, if you look at the infrastructure of capital market today, think about an Italian in the room, like a big spaghetti plate, right? And that's how capital market infrastructure works today. So tomorrow you're going to have one spaghetti across everyone, and everybody will be eating in the same spaghetti. So the problem, obviously, is that in order to start with the technology, you first need to equip yourself. Today, you are leveraging an infrastructure that is requiring you to use wallet, for example, to sign transactions. So you first need to build infrastructure in-house and enable to interact with that. Everybody's focusing on use case, which is great, but if you don't have the current participant of the ecosystem, like the transfer agent, the custodian, the bank, having the capability to service those assets, because there are regulation behind, of course, those assets. If you have a fund, the fund must be serviced by a transfer agent. Debt must be serviced by a custodian. If they don't have the capability to service those assets, then we cannot move forward. So that requires a bit of vision, obviously, for those large financial institutions to understand what is the potential. I think that they all understand the potential. The vision of the spaghetti plate, is obvious for everyone. And I personally have been working for about 10 years at Clearstream Banking, and that's the reason why I invested and joined Tokeny, is because when you understand the technology, you know that this is going to change dramatically the way that capital market operates. But you first need to equip. And then, of course, the complexity behind that is you need to educate your people as well on how to use the technology. And how do you enforce rules and permission? Because obviously, you can have someone having a wallet to sign transaction for the Bitcoin he's buying, but in banks, you have rules and permission. You need multiple signature authorization, et cetera, et cetera. So that infrastructure, takes time to be deployed. So a lot of people are complaining about the speed at which the market is developing. But if you understand that you first need to build this infrastructure to be capable of servicing those assets, and I see all large institutions today, all of them, with very little exception. Of course, maybe some middle tier, small tier banks not, but all the big ones, name it. Give me one name, and I'm pretty sure that I can tell you at which stage they are in implementing the technology. They are all implementing the technology. So it's not a matter of if, it's a matter of when, and they've invested massive amounts of money in building those infrastructure, in building global capability. So I think we're getting there, but we first need to have that level of engagement before we can start, focusing on the use cases.
Thank you. Again, something we hear a lot, I think, recently is that I think maybe we just need to be a little bit more patient. It's coming, but Jonny, what are your thoughts?
Well, I'll move on from spaghetti and talk about a duck, because you've got these big institutions, they're gliding across the sort of the financial services pond, but there's a lot of paddling going on underneath. And very interesting talking to DCCC a couple of weeks ago, and prior to that to Euroclear. And they were very, very blunt and basically saying, look, the train's left. You've got a chance, if you run fast, you'll be able to get on board. This isn't a matter of if, it's a matter of when. And I think you need to look at the slight bigger picture. Most of you are involved to a greater or less extent in financial services. But I think we need to bear in mind that in the real world, where 66% of currently UK employees work, i.e. SMEs, where there's 400 million SMEs globally, they suffer from a real problem. And that's cash flow. Most small businesses don't go bust because they're not profitable. They go bust because they've got to wait 30, 60, 90 days to get their money. So if we can see some form of, bear in mind, this is the Digital Bound Foundation's day, this is about, you can tokenize everything. We know you can tokenize everything. The credit cards have been using tokenization for years. Every transaction they tokenize. So there's nothing new about the technology. We know DLTs and blockchains. We know all of those scale and they work. As the prof said earlier on, he's got a blockchain going since 1995, and it's doing trillions of transactions a month. We know the repo market is doing, it's doing $1 trillion a month at the moment. HSBC, FX everywhere. It's faster and cheaper than CLS. So it all works, but I think perhaps we need to slightly widen our gaze and look what's happening in the real world, and how do we solve those real world problems with SMEs, because whether you like it or not, the agenda has to be on growth, because the amount of debt that we have, not just in this country, but globally, is going to kill us. So the only way is we either default or we find a faster way to grow. So increase productivity, get paid faster, bring in the programmability that Daniel's talking about. But to do that, yes, you probably will need new custodian services like Zodia. But we shouldn't get overly complicated by the technology. We do have a major problem, and that is, as soon as you mention the words blockchain, people immediately say, oh, Bitcoin, Ponzi scheme, I don't want to get involved in that. So it's not education, it's re-education we need. But I think it's worth keeping an eye on the big picture, and the big picture is actually not financial services, but it's actually real small businesses that can really benefit and grow faster, because you've simply got a faster velocity of money. So that's where we see something being really, really useful. We don't tend to talk about issuing debt and buying funds on a day-to-day basis with the retail public, but it's really important for the institutions. So they can get faster and more efficient. Those benefits should actually flow through to faster economic growth.
And if I can just add on your point, you are absolutely right. And as an educator, so from an educator standpoint, we collaborated for years with a number of institutions. We offer training. We try to re-educate them to say, okay, put the penguins and the dogs and the frogs aside for a moment. We all love dogs. We all love frogs, obviously. But put that animals-based tokens aside, and let's discuss, some real use cases. And for instance, and I would certainly, encourage institutions that they definitely need to collaborate more with people like you guys, and more with the, with R3, with Quant, with the crypto world as well. And a great example of it, it was published a couple of days ago, is a Chainlink, who recently partnered with some of the largest financial institutions. Big names like Swift, UBS, Franklin Templeton, they launched an initiative to combine AI, oracles, and blockchains to address the lack of real-time standardized data corporate actions for the post-trade part of it. So this is a very specific piece of the financial landscape, but basically they're helping to distribute corporate action data, which has been always very complicated to do. The report is called, I think, Transforming Asset Servicing. It is a great example of when you see very large established financial institution coming on board with a very innovative crypto-based projects such as Chainlink. So it's those projects like these trying to address very specific problems are the way to go, moving forward.
Fantastic, thank you. I can see the questions starting to come in, but I just wanted to very quickly talk about obstacles. Jonny, I know you touched on sort of the obstacle of education and re-education out there. What are the other obstacles that are in the way that are stopping mainstream adoption, do you think?
Regulation.
Okay. Regulation, education, anything else?
I would say maybe security concerns, you know, like especially when you have the custodial versus not custodial wallets. So this is something that, you know, on the one hand, you have the pros of the custodian wallets where you have easy to use, which is not that easy. I mean, I sit with students and sometimes we are trying to set up wallets, not for financial, as I say, we're not going to provide you any financial advice, but in order for them to experiment with it. And you know, the younger ones, obviously, they are very much tech savvy and they can easily figure out how to do it. The less young, a bit more complicated. So definitely, and also I try to understand how does custodial versus non-custodial wallets work? So how come I can actually, you know, how the digital signature algorithm works? And that is something that may seem complicated for many, but in fact, if you're able to explain it properly, 99% of the population can get it.
Emma, I'd also, if I can say, legislation, and that's a double-edged sword. On one hand, the UK courts or the legislative are proving that they're almost ahead of the movement. We've seen, like, you know, the blockchain bill. We've currently got a bill going through Parliament which is going to make digital assets recognised as personal property. Now, these are real initiatives. This is something which is really helping. Because let's be honest, the UK does a lot of things, invents a lot of sports, which we keep on losing, particularly America's Cup, which is really irritating, but there you go. But we are recognised as a good jurisdiction. To answer to one of the questions was talking about, are we seeing companies relocating? Yes, at one level, but the UK does seem to, it's very, very good at the law. And we are getting some clarification. The downside is, without being too sort of nerdy about it, the UK Proceeds of Crime Bill that was passed in April this year, it means that if you own if I take BlackRock because that exists as a fund, if you buy the normal BlackRock fund, you have less protection if you buy the digitized version. Because the police can come along and seize and destroy a digital fund, a digital asset, with no other intervention. So that is a bit of law that has to be changed, because otherwise, why would you want to hold anything that's tokenized or digitized if you've got less protection than the non-tokenized one? And most people are completely oblivious to that.
And do you have hope for that legislation?
I think that there's enough evidence to show that what we're talking about, this tokenization, this digitization, and again, it's not really our age group. It's, if you like, it's. I think we need to be really careful. The G7 population is basically declining. The power is going to Africa, Latin America, Asia, and they are natively more digital, and we can come up with all the rules and regulations, what you should and shouldn't do, and if we're not careful, end up pointing fingers, you must do it like this. But if you look what's happening in those geographies, they're getting on with it. And I think we need to be really careful not to lose, if you like, the slight edge that we have in terms of people who don't tend to trust us. You must see this in your global mandate. You know, it's all else to sit here in London and say, this is how you make a payment, this is how you tokenize something, but they're actually getting on and physically doing it.
Yeah, I think that's a really good point, and you're totally right, they are just doing it. And in answer to that question, actually, I think you sort of mentioned it at the beginning, it's a bit of a mixed bag, isn't it? Because some companies are relocating to Europe, but also we are seeing companies come to London. They do want to be here. It's interesting to the UK, and I've met with a number of global firms, particularly US firms, who want to open here. So I don't think it's as straightforward as everyone's moving to Europe. I think it's quite mixed, and it depends where you are.
Maybe if I can add on regulation, I think the three guys received last week the Nobel Prize, having worked for 10 years, to demonstrate that the country where you have the greatest economic development, where the country where you had also the strongest regulation. So I think that this is definitely something that we need. We need to keep the balance. And what, of course, we need to keep in mind also is that regulators are not technologists. So if they bring regulation, they need to provide a certain level of agnosticity towards regulation, towards technology, to avoid driving regulation that will create those friction points. Good example of that is what happened in Germany. Germany came up with this EWPG regulation that imposed anyone that represents its stock on a distributed ledger technology needs to use a registrar. The reason why they imposed that is because they were concerned that once you have your shares represented on the public blockchain, that you cannot keep track of it, and if you cannot keep track of it, how can you tax it, right? So they came with this obligation now to have a registrar. Now you have a framework like the one we have developed that enable to indeed enforce control and compliance, so therefore you don't need that regulation anymore. On the other side, because now you have regulation, now the market is exploding in Germany. Now everybody's getting those licenses, and the market is accelerating, moving forward, because they have all assimilated, yeah, it's not the best regulation, but there is regulation, and now it gives the framework that people need and financial institution needs to move forward. Now, if you look at Luxembourg as another example, they have already been driving a regulation for digital asset for more than 2 years, but they kept it agnostic to technology. They say, if you want to use distributed ledger technology, you can do it. And by the way, if you want to use an Excel sheet or Paxos as a fund accounting system, or the blockchain, you can do it as long as you respect the rules. So you need to bring technology that enables to align with the regulatory framework, but in essence, this is not necessarily a technology problem.
I'd also add there and say, in addition to the technology and the regulation, one of the biggest benefits that the UK obviously has with the common law system here is the legal structure and the foundations. In terms of what we were speaking about earlier with respect to the ownership and proving the ownership of those assets, and again, for the institutional or even the SME use cases, being able to have recourse of action and recourse of those assets to the underlying owners should the bank, should the custodian go bust, go insolvent, etc. I think it's really important that here we have that benefit, and we continue to enforce that and take advantage of that, because it's not everywhere in the world that benefits from such a strong legal backbone, I would say.
Yeah, that's a good point. Thank you. We've got 5 minutes, I think. Should we take a quick question? What about, do end customers really want tokenization? Does anyone have thoughts on that?
I mean, I think I can speak about the younger generation. Absolutely, 100%. I have virtually everybody in my class who are 20, 21, or even the more mature student MBA students, they all own crypto assets already. 95%, 90%, they already have it. And in fact, what I was, was listening what Michael, the law major of the City of London, was saying earlier about, these, the risk of having a tax that could go from 0.1 to 99.9%. I can be a bit controversial here by saying, being an academic, by saying I want to see them trying impose that tax. Who is going to vote for a government to actually impose this type of taxation or uses crypto assets in this way? In Parliament, it was the reason why a lot of MPs are starting to listen to more and more of us is because in their constituencies they have pretty high rates of crypto holders or digital asset holders. So when it comes to their re-election, they will have to listen. And yes, there is appetite for it. There is appetite for this type of asset. Particularly younger generation, for them everything is digital. There is no such a thing as a receipt, like a physical receipt. They will look at you in a strange way.
To answer your question, it depends who the customer is. Can you hear me? Yeah, depends who your customer is. If you're the US government, and up until the end of August, it issued 6.6 trillion worth of debt, and some Johnny come likely comes along and says, I can save you 1.2% on that, I think you might get their attention. Because that's the sort of numbers they're talking about in terms of the amount of money you can save by tokenizing debt issuance. Now, don't take my word for it. Listen to the head of macroeconomic research at State Street, one of the biggest asset managers in the world, and I think they're the second biggest custodian in the world. And Elliot believes that you're going to see the entire tokenization of the debt market within 10 years. Why? Because it saves money. Not doing it out of love, it saves money. But if you're a customer, do you want to be paid your income? Do you want to wait every 6 months on your dividends, on your bonds, on your money market funds, or would you like it paid every week? It's a very easy choice. But unless you're aware of that choice, if you own a house and you've got all your equity locked up, most homeowners have probably in excess of 80% of their wealth locked up in their house. If you could actually go and buy a coffee by spending a brick off the top of your house, would you be interested? Well, the answer's got to be yes. But the trouble is that they're not being told about this. So yes, the customers very much, and more importantly from a regulator's point of view, the thing that blockchains give you more than anything else is transparency. And the regulator's job is to protect confidence in financial markets. And if we have greater transparency, that ought to lead to better sort of confidence in the financial markets. And the final one I'll tell you, there was a report out yesterday saying that digital money will increase GDP in the next 5 years by 75%. That's a huge number. And the Bank for International Settlement reckon for every 10% adoption of digital money, it would lead to a 1% increase in GDP over 2 years. So if we just had 30% digital money adoption in the G7 economies, that would equate to a 50% increase in growth in those economies. That would go a long way to solving a lot of the problems that we really do face currently. So yes, I think that it depends on the customers, and different people get different things out of tokenization, but without a doubt, it offers a huge amount of opportunity.
Love that. Very optimistic. I love it. Daniel, Anoosh, any last thoughts before we wrap up?
Well, maybe just one last comment on your previous question, what end customer wants. If you talk about new generation, they want control. I think tokenization is the buzzword for the moment. In reality, tokenization is nothing but representing the assets on another infrastructure. It doesn't change the nature of the asset. As I said earlier, if you want to do that on Excel or on the public blockchain, that's your decision. But young generation want control. And I think that gives them the impression, with the notion of self-custody, they have this in their wallet, they have the Bitcoin, they have the Ether, they have the NFT, they have the ape, the monkey, the ducks, in their wallet.
No spaghetti.
No spaghetti.
What about the ducks?
They have this notion of direct control.
Not yet.
Which is really what they're keen on. And now what we need to do is to provide access to investment opportunity that will enable them to create, what obviously they will use when they will retire after 65, 70, 75 years by then. And so we need to provide access to those assets that we can start investing in, and we of course need also to educate them on how to invest. But this notion of self-custody, this notion of owning directly without any dependence on someone, it started with the parents, right? They don't want to listen, they don't want to go to the bank. So they want that independence, right? I really, this is what we see, and I have 4 children, and this is exactly what they're telling me, independence.
Okay, interesting. Anoosh,
Completely agree. I think this is where the integration of the digital asset space with your day-to-day life, whether that's in financial services or outside of financial services, this is where we need to try and incentivize and make it very easy for end consumers, regardless of who they are, to be able to, like Jonny said, be able to pay for a cup of coffee with a fractional amount of whatever token they are holding, right? Whatever it represents. I typically like to think about the use case in developing countries. So where I'm from in Zimbabwe, inflation is rampant. The use of stable coins or asset-backed tokens there is an incredible use, right? Again, that use, though, is quite limited when you think of, well, how are people going to have access to digital assets, right? Does everyone have a mobile phone? How do you then integrate in the overall end-to-end flow the digital asset space, the ability to disperse cross-border payments easily, cheaply, with, at the end of the day, the end user in this case, who may be an individual sitting in Zimbabwe without access to a mobile phone? How do they then get access to the likes of the MoneyGrams that are closest to them in order to be able to use that? So this is where I think it's truly an end-to-end integration that needs to happen here, and an end-to-end overall consolidation in terms of how the two worlds work together.
Wonderful. Thank you. Well, it's been an absolute delight to be up here with you all today. Thank you, Jonny, Daniel, Anoosh, and Francesco. Huge thank you to the DPF, Clifford Chance, and all the sponsors for today.